And one other thing we need to turn on here. Come on, bring that down here. Let's see. Whoops. That's not what. There we go. Okay. So what I want you guys to realize, we're going to finish this out. Remember our initial equation, okay? So we're talking about cash flow. And the other day, we talked about income statement, balance sheet. We're going to use the income statement and balance sheet to, to talk about and figure out our cash flow. Now, if we go back to our initial equation, the total assets equals total debt plus total equity, okay? We're going to talk about cash flow from assets. Think back to our capital budget, capital structure conversations, okay? So the first thing we're going to look at is cash flow from assets from the left side of our balance sheet, our asset side. So from operating our business, what we invested in, the machinery, the buildings, all that stuff, from operating our business, we're going to develop cash flow. Now, do we get to keep all of that cash flow? No. Where does it go, Omar?
I don't know.
It goes to the people who gave us money to be in business. Now, if you put all the money in the business and you're a sole proprietorship or the sole owner of your corporation and it's 100% equity owned, then yes, you get to keep all the money. But if you didn't and you had to borrow some, right, then we go to the right side of our balance sheet and our cash flow from assets has to go to the people who gave us the money to be in business, our creditors and the equity. Okay. So that's what we're going to discuss today. And then we're going to get into some of the problems. Now, hopefully, did you guys look at the problems? How did they go?
I stopped after 9.
You stopped after 9.
Yeah, they were. I was looking at the solutions, and like after I was looking at solutions, it was good because it was step by step, but there were just a lot of different like formulas and stuff. So it just seems like a lot.
Yeah, I mean, like, yeah, you kind of have to have a good visualization of what like a balance sheet would look like, income statement would look like, and all that, which is kind of why the solutions manual is pretty helpful.
There you go. And we're gonna help clear up all that stuff today, Kylie and Omar. Okay. So first thing we got to get down to is what is cash flow. So let's look at cash flows. Again, we're going to start with the left side of our balance sheet, the cash flow from assets from our operation. Okay. So when we hear cash flow from assets, you're going to see this CFFA. I like to, I'm going to shorten things down because that's just a lot of writing. Okay, what do they call them? Where you just use the letters?
Acronyms.
Thank you. Acronyms. Yeah. And I was thinking anagrams. I'm like, that's not it. But acronyms, is that what you said, Omar? Okay, acronyms. Okay, so you'll see that a lot. Now, cash flow from assets has 3 parts, folks. If you look, the first one is operating cash flow. We take operating cash flow, we subtract out net capital spending, and we subtract out our change in net working capital. So those are the 3 parts of our cash flow from assets. Now, what I want to do is look at each part individually. So first, let's start with operating cash flow. So operating cash flow, or OCF, is earnings before interest and taxes plus depreciation minus taxes. Okay. Now, where are we getting earnings before interest and taxes, depreciation and taxes? Where does that come off? What does that come from?
The balance sheet.
Not the balance sheet, Katie, but
Or the income statement.
the income statement. Very good. Very good. Okay. So we get that off the, and that's what we're going to do on both these. We're going to go back and forth from the balance sheet and the income statement to pull our numbers and get the items that we need. I'm not going to throw numbers in here. We'll do that with the problems. So it may seem a little like confusing at first, but trust me, with the problems, I'm going to walk you through step by step on how to calculate that. So with operating cash flow, earnings before interest and taxes. Now, we're adding depreciation. Kayla, you said we get these numbers from the income statement. On the income statement, what do we do with depreciation on the income statement?
We subtract it.
We
Out.
subtract it. So why is it a subtraction on the income statement and an addition when we're talking about operating cash flow?
That's because depreciation's an accounting number, and so we have to add back in depreciation to positively reflect, not positively, accurately reflect cash flows.
Exactly. On accounting, right? Depreciation, we take it out. Depreciation's nice because it lowers our taxable income and thus lowering taxes, right? Well, remember, what did we call depreciation? We put this in our notes the other day. We said depreciation was what?
Non-cash.
There you go, Kirsten, a non-cash expense, right? When did we actually spend the money? When we bought the asset or when we built the asset or whatever, right? That's where we actually spent the money. But depreciation allows us to take that one-time expense and spread it out through the life of the asset. So that's why we spent the money the day we bought it or built the asset, but later on, we're taking that off our income statement, but that money's still in our account. So it's a non-cash expense. It's just a paper expense, okay? All right. So let's take a look at the second component here, net capital spending. Okay, notice you see net there. I have that underlined. Anytime you see net, we are going to have to do some math. Okay, so with net capital spending, it's our ending fixed assets minus our beginning fixed assets plus depreciation. So anytime we have a business during the course of the year, we may sell assets. When we sell those assets, we lose that depreciation that's tied to that asset. But if we go buy a replacement asset, we're gaining the depreciation on that new asset, okay? So when we look at the depreciation on our income statement, it is really the depreciation that comes from, that's what's left from buying and selling other assets, all right? This is going to become very important, folks, because what we're doing now is going to tie into the project that we do at the end of the semester in chapters 9 and 10. Okay, so it's going to tie in there. So you want to start making sure we're getting this stuff down. So net capital spending, ending fixed assets minus beginning fixed assets plus that depreciation. Okay, the third part of it is our change or delta, meaning change in net working capital. Again, with net working capital, we know that's current assets minus current liabilities, okay? When we're talking about the change in net working capital, it's our ending net working capital minus our beginning net working capital, okay? So from that, that's the cash flow from assets on the left side of our balance sheet. You can see we got the three components there, right? So we developed our left side of our balance sheet here, total assets. If we develop the cash, let's say it was $100 worth of cash. We don't get to keep all of that unless we are 100% equity owned. So if we had to borrow some money, we got to pay those people back that we borrowed the money from. Okay. So again, we're dealing with our balance sheet, where our capital budget, capital structure, how much do we need to have to start our business? Where's that money coming from? When we get in business and get running, we don't get to keep it all. We got to pay those back that gave us the money. So if we developed $100 in cash flow from our assets, right? When we look at the right side of our balance sheet, we got to account for that $100, and it's going to creditors or stockholders. It might be 60-40, 70-30, 20-80, 10-90, 50-50, whatever. Basically, the cash flow from assets on the left side of our balance sheet have to equal the cash flow from assets on the right side of our balance sheet. Okay, and that's what we're going to get into next. So any questions on what we've done so far? Is everybody good?
Can you scroll up a little bit so I can finish writing down the third one?
Where do you need me to go, Matt?
The third one.
Right there?
Yep.
Okay. All right, you good, Matt?
Yes.
All right. So now let's go to the right side of our balance sheet. Let's look at cash flow from assets on the right side of our balance sheet. Okay. So you can see we have our initial equation here, right? We developed our cash flow, but our cash flow from assets now on the right side of our balance sheet, it has two components. One, cash flow to creditors, and the second, cash flow to stockholders. Okay. So again, we're going to break each one of these down. When we look at the first component, cash flow to creditors, creditors get paid what? When we calculated bonds or when you get a loan, what do creditors get paid?
Interest?
Interest. There you go, Madison. So when we look at cash flow to creditors, it's the interest paid minus any net new borrowing. Okay. Now, again, here's that word net. So when we talk about net new borrowing, we're looking at ending long-term debt minus beginning long-term debt. Okay. So that's part one. The second component of the right side of our balance sheet is our cash flow to stockholders. Okay. Cash flow to stockholders, stockholders get paid dividends. So it's dividends minus net new equity. Okay, so we're talking about net new equity. Ending owner's equity minus beginning owner's equity. Now let's talk about owner's equity for just a minute. What makes up owner's equity on our balance sheet? Three things, right? Common stock, paid in surplus, and retained earnings. Common stock, where does that come from? We're selling stock. We're selling ownership in our company. Where does the paid in surplus come from? That's the owners putting money into our business, right? What about retained earnings? Where does that come from?
Balance sheet?
Yes, Wilson, we find it on the balance sheet, but where does the money come from?
The net income on the income statement?
There you go, Madison. The net income on the income statement. How do we get net income?
Do the earnings before taxes minus taxes, like at the end.
Okay, Kaylee, keep going. You're on the right track. Somebody help her out. Don't leave her out. She went out on the limb and y'all are like, she's out on the limb and you guys are shaking the branch. You guys aren't even helping her out, man. Come on, help her out a little bit. So go ahead, Kaylee, repeat what you said. Net income, earnings before taxes.
Yeah, earnings before taxes minus taxes. And then net income consists of dividends and retained earnings.
Okay. So how did we get the net income?
The business's revenues and expenses?
Revenue minus expenses. Very good, Madison. Right? So we got the net income from operating our business, right? We were operating our business. That generated sales and expenses and the interest and depreciation and the taxes that we had to pay. And that gives us our net income. Then Madison said our net income goes two places, dividends and where else, Madison?
Interest or taxes?
No.
The retained earnings.
The retained earnings. There you go, Kaylee. Kaylee's helping you out. Okay. So when we're talking about the owner's equity, when we're looking at cash flow to stockholders, if you notice, I got a red X through return on equity there because we don't count return on equity in, or retained earnings in owner's equity because we generated that ourselves. We did not go out and sell stock or ask the owners to pitch in money. We self-generated that through operating our business. So when we're looking at owner's equity and cash flow to stockholders, leave out retained earnings. Okay, it's very important. Students do it all the time. They look at that and go, oh, cash flow to stockholders, that's owner's equity. So they take all that and throw it in there. They forget to take out the retained earnings. Okay. All right. So
Wait,
now,
I must have just had a lot. Why did you say we have to take out retained earnings out of stockholders' equity?
we take it out of owner's equity, not stockholders' equity, owner's equity, Wilson. And we do that because we generate that ourselves through operations.
Okay.
Okay. Through running our business, operating our business, we're generating that money. Okay.
Yes, sir.
All right. So there you go. We got our cash flow from cash flow from operations. The first part we did operating cash flow, net capital spending, net working capital, and we generated that cash flow, right? The second way we got cash flow from assets is cash flow to creditors and cash flow to stockholders. Those numbers have to equal. Okay. Everybody good? Any questions?
Oh, sorry.
Oh, you can go ahead first.
I just had a quick question for the owner's equity. So you said it was common stock, and then what was I know you said take out retained earnings, but what was the other part of it?
Whoops, paid in surplus.
Okay, thank you.
Paid in surplus. Matt, what was your question?
So my internet's being pretty crappy and like your voice is chopping out. I see you're recording this Zoom. Can you send it to me after this class?
I'll try to post it. Yeah.
Okay, thank you.
It might be a while. It takes it a while to download depending on how much I talk and how much annotation's going on.
Well, like I can hear you, but like sometimes the annotation's not matching up with your voice, and I'm pretty sure it's my internet. So
Okay.
like you'll be talking about something, but like it's completely something different on my screen.
That's kind of like the old karate flicks back in my day, man. It's like they would talk and then their mouth would move.
Yeah, it's basically like that right now for me.
The old Bruce Lee movies, Enter the Dragon and all that good stuff.
Did you go back
It's not that old. I watched Enter the Dragon recently.
Oh, did you? I tell you what, man, he was one person that was crazy. He was insanely in shape. All right. So let's put some of this to practice. Let's see if we can clear up any confusion, and let's jump into some problems here. Okay. Like I said, we're going to build a little at a time. So hang in there. We'll see if we can get Omar past problem 9. Okay. So, and unfortunately, you guys have figured it out. The exam doesn't tell you, hey, in this problem, we're building a balance sheet. But the homework says we're going to build a balance sheet. So you should be able to kind of figure it out from the information you're given. I mean, if you're given current assets and fixed assets, that's on the balance sheet. Okay. So we're going to build this balance sheet. We know current assets are $4,900. Okay. We know fixed assets are $27,300. Okay. We know current liabilities is $4,100. Long-term debt is $10,200. And really that's all we're given, and we're asked for owner's equity. Ultimately, that's what we're asked for, okay? So with the information we're given here, what can we calculate?
Total assets.
Yeah, very good, Carson. We can calculate total assets. Total assets, 0, 0, 9, and 3 is 12. Carry, that's 5, and 7 is 2. Carry it, that's a 3. So 32,200 is our total assets. What else do we know looking at our balance sheet? Total assets has to equal total liabilities. So we know this is 32,200, right? So how do we get to owner's equity? Subtract out long-term debt and current liabilities. And what do we get for owner's equity here?
I got 17,900.
Yeah, 17,900. Okay. Then the next part of the question says, what is net working capital? We know that's current assets minus current liabilities. So 4,900 minus 4,100. So we know net working capital $800. Okay. Is everybody good there? So we're off to a good start. Okay. Let's look at problem 2. Okay. Problem 2 says, hey, we're going to build an income statement. But if you look at it, anytime you see sales, depreciation, tax, all that good stuff, you know that's an income statement, right? So when we look at our income statement, we know we had sales, cost, depreciation. That gives us earnings before interest and taxes. Then we have interest, earnings before taxes, take out our taxes, and we get the net income. Okay. So we have a goat farm. They have sales of $796,000. Okay. They have costs of $327,000. Now, let's talk about costs for just a minute. We talked about that the other day. What goes into costs?
Like wages and utility costs, things like that.
Wages, utilities, what else? Insurance, rent, mortgage, right? Fuel, heating. So there's a lot of stuff going into costs. Don't forget that. Okay. All right. Next, we have depreciation, $42,000. Okay. So that gives us our earnings before interest and taxes. Now, when we're subtracting, I can do the first 3 numbers there pretty easy. What's the other 3?
427.
427. Okay. Very good. Thank you, Kirsten. All right. Then we have, let's see, an interest expense of $34,000. So 2 numbers I can handle myself a little bit. 3, that's where you guys are going to have to come in and step in with your calculators, right? Then it says taxes. Now with taxes, the book is either going to give you the amount of taxes or it's going to give you a tax rate. In this case, it says the tax rate's 21%. So what's 21% of 393?
82,530.
82,530. Okay. So we get the net income. I know this is 470. What do we get for the rest of our net income?
310.
Okay, 310, 470 is our net income. All right. Everybody good there? Pretty straightforward. All right. Questions 3 and 4 revert back to problem 2. Okay. Now, it says, suppose the firm paid out $95,000 in dividends. What's retained earnings? So we already know with net income goes 2 places. One is dividends and the other retained earnings, right? So in problem 3 here, it says they paid out $95,000 in dividends. So that means retained earnings is how much?
It's a 215, 470.
215, 470. Now, where's that going? Where does that go?
Does it go back into the company?
Goes back into the company. Where do we see it reflected though?
Does it go back to the balance sheet or no?
Yes, that goes back to the balance sheet under our retained earnings. Okay. So the only place our income statement and balance sheet are connected really is retained earnings. Okay. So this is going over to the balance sheet under retained earnings. What are we going to do with it? What did we call this the other day?
Plowback.
Drawback.
Plowback. Very good. What do we do with that?
Reinvest back into the company.
We reinvest back into the company to grow our company, right? Okay. So with that, let's take a look at number 4. So number 4 says, suppose the firm in problem 3 had 80,000 shares of common stock. What is earnings per share? So earnings per share is net income divided by number of shares. Okay. So our net income was 310,470 divided by 80,000 shares of stock. So our earnings per share is how much?
388.
$3.88. So what does that mean? Tell me what that means.
Essentially, what for every share of stock they made 388, right?
Yeah. For every share of stock, the company made $3.88. Rocking and rolling, right? Omar's feeding his little Omar steak and lobster on that, aren't you? Not on one share, right? Okay. Now, if we look at the rest, the next part of the question said, okay, dividend, what is dividends per share? Dividends per share is obviously dividends divided by number of shares. Okay. So we said they paid 95,000 in dividends. So what is dividends per share?
It rounds to 119. $1.
Okay, $1.19. So the company earned $3.88 per share of stock, okay? But they only paid dividends of $1.19 per share. So where's that other two, if we round it, let's just say 270. Where's that other 270 going? Actually, it's 269, I guess. Where's that going?
Retained earnings.
There you go, Aiden. Retained earnings. Now, Aiden, are you upset that because the company's keeping most of the money they earn? Are you upset at that?
Just depends how they use it, I guess.
Okay. Depends on how they use it. Hopefully that money is going back into retained earnings, right? So hopefully they're investing back into the company. Why might we not be upset if they're investing back into the company?
Because it shows they have potential for future growth.
For future growth. With future growth, what's going to happen to my future dividends?
They get bigger.
They get bigger. What else might get bigger?
Share price, I guess.
Share price, yes. Exactly. And what's our ultimate goal? Page 9, orange box, top of the page. Remember, I told you we'd refer back to this over and over and over again. What's that ultimate goal? Anybody remember?
Essentially, to grow the share price.
Maximize shareholder wealth. So if my dividend's going up, my stock price is going up, isn't my shareholder wealth going up? Bingo. Goal accomplished. Okay. Everybody good? All right. Now then, let's take a look at number 5. Okay. Problem 5. We see we have sales costs. Guess what we're going to have to do? Income statement. Okay. So we see this company, Pompeii Inc. Hopefully they weren't too close to Vesuvius when it blew up, right? So this company didn't have a very long future. But hey, they made some money. They made $46,200. Okay. Our costs were $23,100. Wow, look at that. Cost is 50% of their sales. That's pretty high. Okay. Depreciation was $2,200. Okay. So earnings before interest and taxes. What's our number there?
$20,900.
20,009.
Mm-hmm.
Thank you. Okay. All right. Then we see we had an interest expense of $1,700. Now, really, for what we need to calculate, because they're asking us to calculate operating cash flow, we could stop there, but I'm a little OCD, so we got to finish the whole thing out. Okay. So our earnings before taxes is 19.2. Our taxes is 22%. So what's 22% of 19.2?
4,224.
Okay. So that leaves net income at what?
14,976.
Okay. All right, there you go. So there's our income statement. But the problem says, hey, what is operating cash flow? Operating cash flow, earnings before interest and taxes plus depreciation minus taxes. So I look at my income statement. I just pull these numbers off the income statement. 20,900. Depreciation's 2,200. Now again, why can we add that in on our operating cash flow? Because it's what?
A non-cash expense.
There you go, Madison, a non-cash expense, right? We're going to take out our taxes. Okay. And what's our operating cash flow here?
You got 18,876.
There you go, Kirsten. So if we look, our operating cash flow is actually more than our net income. And remember, net income, right? That's going to dividends and retained earnings. So this 18,876 is the money we have to operate our business. Okay. That's why it's called operating cash flow. Is everybody good there? Any questions there?
I have a question.
Yes, ma'am.
What does the difference mean, like in words, between the operating cash flow and net income?
Okay. Just that, okay? Operating cash flow. Operating cash flow. Money that you have to operate your business is 18,876. That's money you can pay your bills with, pay your employees, your utility bills, vendor, something like that, a supplier, right? Net income, that's the money left over after you've taken out all your business expenses. That's the money that you have left over in your business, Kirsten. Now, do you get to keep all the net income?
No.
Depends. If you're a sole proprietorship or you're the sole owner of your company, Kirsten, that's all yours, right? But if you had to borrow some money to get into business, some of that is yours and some of it goes to the people who loaned you the money. Okay. That's what we see when we talk about cash flow from assets, what we're going to deal with here in the next few problems. But as far as this goes, our net income goes to dividends. If you notice, we've already taken care of our creditors right here. So the people that you borrowed money from, you've already taken care of them with interest, hopefully paid some principal too, right? So after that, it goes to the dividends, the owners of the company. So if you're the sole owner, that all can come to you. Or if you have stockholders, it's going to them, right? And then the other part's going to retained earnings. Hey, I don't need all that money, but I want to grow my business. I don't want to have to go borrow it, and I don't want any more owners involved in the company. So I'm going to take some of that net income, some of that 14,976. I'm going to put it back into investing into my company. Okay, does that help out?
Yeah, that makes sense. Thank you.
Okay. In one of the previous classes, I had a question. They were asking about depreciation. And they said, hey, why doesn't everybody just straight line do depreciation straight line? It makes more sense, right? So I left this slide in here to talk about this question just a little bit, okay? If we look at it, let me erase this part right here, okay? So when we start our business, we start down here. What are we doing at the beginning parts of our business? We're figuring out how to operate, how to become more efficient, right? Improving the quality of our product. Why do we practice, Carson? Are you a much better player now than you were when you first started playing soccer?
I would hope so.
Yeah, I hope so too, right? I mean, before then, you didn't know what offsides was. You were just like, hey, kick the ball down the field. I love watching little kids play soccer. It's a mosh pit around the ball. Because wherever the ball goes, there's 20 kids standing around. And they're all kicking each other in the shin, hoping it goes somewhere, right? But afterward, so you get that expertise, you start figuring out your process, becoming more efficient, getting a better product, you're building your customer base, and then your business starts growing, right? So right here, you know, when you look at your business in this section of your business, your expenses are high, your income might not be very high, you don't have a whole lot of cash flow, okay? But then your business grows, and that's where you're up in here. Your customers are saying, hey, we need to go to Kirsten's shop. She really knows what's going on. She's got great product, great service, and the business grows and then it matures, right? So if we look at straight line depreciation, if we do straight line depreciation, that's just what that nice angled line is, okay? Now remember, depreciation is a non-cash expense. So that's money you have available to spend on your business, okay? The other way we can do depreciation is our makers down here. Now remember, who wrote our tax laws? Businessmen, right? So with makers, the modified accelerated cost recovery system, our depreciation is front loaded. Why is that? Well, because now with all my depreciation up here, notice what's happening to my cash flow. With that depreciation increasing my cash flow is now up here, okay? So it helps to offset that newness of the company, gives me more money in my business, and then as I become more proficient, I don't need as much cash flow in my business because I've established it. I got customers who know my product, they're bringing other customers, so I don't need as much readily, I don't need as much cash flow to offset some of that. Does that make sense? So that's why we have different types of depreciation and what that means to our business during our growth cycle. Okay. So that depreciation gives us more cash in the early part of our business to grow. Okay. And to operate. Make sure our bills are paid. Is everybody good there? Does that make sense? Nobody's saying anything. I'm not sure. So I'm going to take silence is a yes. All right. So we'll move on then. So let's look at another problem. Let's look at number 6. So with number 6, now we're starting to get into our cash flow from our assets. So we're getting into what we talked about today. Okay. With number 6, we're looking at net capital spending. So remember, net capital spending, we have the word net there, so we got to do some math. That's ending fixed assets minus beginning fixed assets plus depreciation. So with this problem, we're taking care of all our NASCAR enthusiasts, Logano Driving School. We have a 2017 balance sheet. Okay, 2017 showed our net fixed assets of $2.4 million. That's our beginning number. 2018, our ending number showed our assets at $3.3 million. And then we had depreciation in there of $319,000. Okay. So they want to know what was the net capital spending for 2018 for Logano's Driving School. So I got the first 3. I can do that one. So what did Logano's Driving School spend on net fixed assets during the course of the year?
$1,219,000.
Okay, $1,219,000. Okay, net capital spending. Is everybody good there? Now, folks, I'm going to caution you. Pretty much from here on out, what we're doing is basic math. Addition, subtraction, we get a number. You got to get out of that mindset. You got to start thinking like a business owner. What is this number telling me about this business? Okay. So when we look at this, And this is going to carry into what we do in chapter 3 especially, but also moving forward, right? We're going to, each number we get is a little piece of a puzzle, kind of like a jigsaw puzzle. You got to put all this information together, put all the pieces together, and that gives you the full picture of the company, okay? So if we look at Logano's driving school, think about it. They went from 2.4 million in assets to 3.3 million. Why would they need another $900,000 in fixed assets, do you think?
They're expanding their business.
Exactly. They're growing the business, right? That the reason we expand and we need more assets, hey, it's a driving school. They can't put any more students into the race cars. So the only way they can grow the business is to have more race cars, to put more students in, to teach them how to turn left on the track, right? I mean, think about it. What's NASCAR? Push the vertical pedal all the way to the metal, as far down as it'll go, and turn left. Don't turn right. Of course, now they have road tracks, so you got to do some right turns. But before that, it was get in, turn left, okay? Anybody ever gone to the Christmas lights at Charlotte or Bristol? If you ever get a chance, go do it. It's kind of cool because a lot of times they let you drive on the track. And I took my kids out to Bristol to do this one time. And they always say the banks at Bristol, since it's a half-mile track, are really steep. Man, my kids started out on the right side of the car. When I went through the bank, they were all piled up on the left side of the windows, face pressed against the window, man. The bank's like a 30-degree bank. It's kind of cool. It's really neat. So if you get a chance to do it, it's fun. So what we get here, though, is that Logano had to invest in assets, probably more cars, because he couldn't teach more students unless they had more cars. So if you're maxed out on your assets, there's only two ways to grow the business, right? You either need more capacity, or if you're maxed out on the capacity, what's the other way to grow the business, grow sales?
Decrease spending.
Increase the price. But the problem is, if you're in a price sensitive area, you might not be able to increase that price, right? So you got to have more of the product, okay? So is everybody good? Everybody see what he kind of did here? Because I'm going to ask you that in the next few questions too. I want you to tell me what's going on with the company, okay? So let's look at number 7. Number 7, we're talking about additions to net working capital. Number 7. Net working capital, we know it's current assets minus current liabilities. So we have Dream Inc. showed current assets, okay, 2017. So we have 2017 current assets minus current liabilities. Current assets of 4810 and current liabilities of 2230. Okay, 2018. Again, current assets minus current liabilities had 5360 current assets and current liabilities of 2970. So what we're looking for here is the change in net working capital. Before we do that, let's handle each one of these years separately. So what's our net working capital for 2018? Somebody take the 5360 minus 2970. What do we get?
2390.
2390, Kate?
Yeah.
Okay, thank you. Okay, 2017, 4810 minus 2230.
2,580.
One more time,
2580.
2580, okay? So what happened to our net working capital here?
Our assets exceeded our liabilities both years.
Okay. We went down $190, right? What's net working capital? That's the money we have to operate our business, right? That's what we're paying vendors and utility bills and payroll and all that stuff with. It went down $190. Is that necessarily a bad thing? Is that bad? Is it
Yeah.
good?
It is bad?
It's not
Okay.
good or bad. It just depends on the situation. So, I mean, that 190 could have been just efficiency.
Exactly. A lot of the answers to a lot of our questions is that good or bad? It depends. It depends on what's going on. What you see here is, hey, let's throw a flag up. Let's analyze, why did our operating cash go down? What are some of the causes? So if we look at that, remember, current assets. So what did we do with our current assets over the course of the year? What happened in current assets? And remember, what are current assets? Cash, accounts receivable, and inventory. Okay. Now we don't know which one of these categories we affected. We just know as a ball of wax between the three of them, we increased that roughly, what, $550, $450, something like that. So we increase current assets. What may have caused? We're probably not going to increase cash, right? Accounts receivable, maybe we changed our credit policy and we got more sales, but we loaned money to more people. We gave we let them buy it on account. We gave them credit. So that may have been the case. So we increased that. We're going to analyze that in the next chapter, chapter 3, right? We could have found out, hey, the inventory going into our product, we have some bad product, and the reason is because of the inventory. So maybe we got better inventory going into our product that costs more. So again, it may be good, it may be bad, Madison. We're not sure. We need to dive in and see what's going on, okay? Now, what happened to our current liabilities? We talk about accounts payable and notes payable. What happened with current liabilities here? They went up also, right? They went up more than our current assets. So we increased our current assets, but our current liabilities went up more. Why? Well, maybe we had maybe we increased our accounts payable more. Maybe we had to go get notes payable. We're not sure. But typically, anytime we see an increase in current assets, we expect current liabilities to go up because of this right here, inventory and accounts payable. Right? Why do we see a connection there? And if one goes up, why would the other go up?
Don't you usually buy inventory on account?
Why is that, Aiden? That is true, but why?
You use I forgot what exactly it is. It's like you use the money to something like that. I forget.
We use money, yeah. Whose money do we want to use, Aiden?
Their money.
Other people's money. We want to use other people's money. See, and this is, folks, I'm starting to ask you to get out of being the employee mentality into the business owner, business management mentality. Okay. This is why you guys are studying business. Okay. I want to use other people's money. So even if I got better inventory, Aiden, I'm going to ask you, hey, you let me pay you 60, 90 days from now. My hope is that I do what with that in the meantime, Aiden?
You turn your inventory around and sell it.
Yeah. I take that inventory, turn it into my product, and I go sell my product to Bethany and Kirsten and Miller and Hector. And then I use their money to pay who? You. Right? So I want to use other people's money to run my business. So anytime we see current assets go up, we expect liabilities to go up. Now, Madison, is that necessarily bad?
No.
No. However, if I see that year after year after year, that's probably not a good thing. But if I see it one time, it's like saying, hey, Madison, come investigate why this happened. Analyze this. Be able to tell somebody why that happened. Does that make sense?
Yes, perfect sense.
Is everybody good there? Are you starting to get an idea how you need to change some thought processes maybe? Okay. All right, let's look at number 8 then. Okay, so we dealt with net capital spending. We dealt with net working capital. Okay, if we look at number 8, we're looking at cash flow to creditors. Okay, now remember, cash flow to creditors get paid interest, okay, minus net new borrowing. So our net new borrowing is ending long-term debt minus beginning long-term debt. Okay, so if we look at number 8 here, we got this tennis shop. Okay, their 2017 balance sheet showed long-term debt of $1,870,000. The 2018 balance sheet showed $2,210,000 in long-term debt. Okay. Our income statement said, hey, we paid $255,000 in interest expense that year. So we want to know what's our cash flow to our creditors here. Okay. So let's take this a step at a time. What's the 2.21 minus 1.87? What's that number?
$340,000.
340,000. Okay. So if we look at our cash flow to creditors, though, what do we notice? What just happened?
It's going to be negative.
Negative how much?
85,000.
$85,000. So somebody tell me what did we do here? What happened here?
We had more long-term debt overall than the interest, and so there's just like more debt, I guess.
Yeah, exactly. We went out and got more debt. So if we look at it and think of debt as a hole, did we fill the hole in or did we dig it deeper? We went deeper. We dug our hole deeper. Is that a bad thing? Madison?
Yes.
Again, it depends, right? Remember, I said these numbers, it depends. In personal life, is that a bad thing? Absolutely. Okay, in your personal finance, in a business finance, it depends. What did we do with that debt? If we took that debt and we were Joey, Logano's driving school, and we used that money to buy new cars or more cars so we could get more students in, that's not necessarily a bad thing. Okay. If we had to go get that debt to keep our business afloat and pay off some bills or pay rent or pay payroll, that's a bad thing. All we're doing is kind of kicking the can down the road. We're going to face it sooner or later, right? So it depends on what we're doing with the money that we got. Like you said, we've got more debt than what we paid back. So we dug our hole deeper. Is that bad? It depends on what we're doing with the debt. If we're investing in assets, hopefully that's going to increase sales and grow the business. So not a bad thing. Does that make sense? Now, again, in this problem, we don't know what that is. We aren't told that, okay? Is everybody good? Any questions on that one? All right, everybody's good. Bethany says she's got it and ready to rock on. Okay, let's look at number 9. So if you notice with these two problems, we're on the right side of our balance sheet. We dealt with the creditors. Now we're going to deal with the stockholders because we're still with the tennis company, okay? Now notice here, cash flow to stockholders, dividends minus net new equity. Okay, when we talk about new equity, what are we including and what are we leaving out?
So you include the common stock and paid in surplus, but you exclude the retained earnings.
There you go. Good job, Madison. Okay, so if we look at this, the balance sheet showed 650 in 2017 in common stock. So this is 2017, okay? and 3.9 million in paid in surplus, or I'm sorry, 9.8 million in paid in surplus. Okay. In 2018, common stock was 805,000, and the paid in surplus was 4.2 million. And the dividends that we paid were 545,000. Okay. So let's deal with let's take this step by step. So what is my 2018 number? 5,005,000, right? 2018, 2017. What's the 2017 number there?
I got 4,630,000.
Okay. So 545 minus, what's the 5,005,000 minus 4,630,000?
375,000.
One more time, Kim.
375,000.
Thank you. Okay. So our cash flow to stockholders then is how much?
170,000.
$170,000. Okay. Now, when we look at this, we did sell stock, right? We sold $155,000 in stock, right? What's the downside to selling that $155,000 worth of stock for my current stockholder?
Can you repeat that one more time?
The $155,000, we sold that in stock, right, Madison? So what's the downside for my current stockholders of doing that?
Doesn't it dilute the shares?
It deletes the shares, Aiden, except for what? Remember, what's one of our rights as a stockholder?
You get to purchase them as soon as they come out or whatever.
We get the right of first refusal, right? So Aiden, if you own 20% of this company, guess what you'd have to do if we issued more stock?
20% of whatever the offering was.
Exactly. You'd have to buy it to maintain your ownership, or you're going to lose ownership in the company, right? So from a stockholder's point of view, it's like, wow, you guys issued more stock. Now I got to buy that stock. Notice also what happened to my paid in surplus. It went up $220,000. So not only, Aiden, did you have to buy stock, but we had a paid in surplus also. Okay. So both things happened there. So if you're a current stockholder, now Madison, if you didn't own stock and you wanted to, now you could buy it. You could buy into the company. But Aiden, as a current stockholder, had to buy that percentage of the new issues or he's losing ownership. Okay, does everybody see that? Is everybody good? Okay, now Omar, this is where you said you stopped?
What's up?
Is this where you said you stopped?
Yeah.
Okay. All right. So folks, we have cash flow to creditors, we have cash flow to stockholders. That gives us cash flow to assets. Okay. We were on the right side of our balance sheet. So probably in question 10, we're going to carry that number over to the left side of our balance sheet. And that's exactly what we're going to do here. Okay. So if we look at it, okay, given the information in 9 and 10, okay, so let me erase this. Okay, so we had cash flow to creditors and cash flow to stockholders. We said this was minus 85,000 and this was 170,000. And we know cash flow from assets equals cash flow to creditors plus cash flow to stockholders, right? So this was negative 85,000 plus 170,000. So that means my cash flow from assets then is equal to what? $85,000. Okay. So that's what I know from problems 8 and 9. So this is problem 8, this is problem 9, and that's what I know. Now, it says, now that we know that, let's say the firm's capital spending was $1,250,000 and the firm reduced its net working capital investment by $45,000. So what's the firm's operating? So we know cash flow from assets on the left side of our balance sheet is operating cash flow minus net capital spending minus the change in net working capital. Okay. From problems 8 and 9, I know cash flow from assets is 85,000. What I'm looking for is operating cash flow. Okay. They say they don't now with net working capital, they don't say give you ending and beginning and depreciation. They just say, hey, whatever we did, the net outcome of that was $1,250,000, right? Now, when it comes to the net working capital, again, they don't give you current assets, current liabilities in the 2 years. They just say, this is what the net effect was from our net working capital. And what is that net effect?
The 45,000.
What about that 45,000 though? There's a very key point there.
It's negative.
They reduced, so it's a negative 45,000. Now, folks, tell me something. Anytime you see this, what does that mean?
It's addition.
A minus and a minus turns out to be a plus, right? Very good, Aiden. Okay, so let's take this. So we got 85,000 equals operating cash flow minus $1,205,000. Okay. Does everybody see the math there? Does that make sense? Omar, you look like the tank's moving, but the treads are turning, but the tank's not going anywhere. You're just blowing smoke, man.
I was like, where in the hell did the negative 45,000 come from? But that was from the net change or just a change in?
Yeah, well, it says the firm reduced its net working capital by $45,000.
Okay.
So our net working capital went down $45,000. Okay.
Right.
We don't know what the number was. We just know the change in the net working capital was a minus 45,000. Okay. So then we take and add it to this side. Then we add it to this side. And we get operating cash flow equal 1,290,000. Okay. Everybody good? Does that make sense? So a lot of times, guys, you're going to read problems, and these problems, especially from here on out, the problems are going to be like, woo, that's a big, long problem. Take it a bite at a time. How do you eat an elephant? Don't get all crazy on me. Just how do you eat an elephant? Anybody know? One bite at a time. You don't take the elephant and try to swallow it whole. You eat it one bite at a time. That's what you got to do with these problems. And if you notice, that's kind of what we've done in this progression. Okay. Is everybody good? Any questions? Omar, does that kind of help you out? Is that what kind of, you said you stopped at 9. I'm not picking on you. You said you stopped at 9. Nobody else said anything. So you're the only one I kind of have to talk to right now. Why did you stop at 9, and does that help clear that up?
Because one, I ran out of time, and then two, they were starting to get there are a lot more variables, and I was like, you know what, I'm
I
tired.
got tired of thinking about it.
Yeah. I'll say this, I'm taking calculus 2 in a coding class, and this is probably like the harder class out of all of them. So. Just because like my mind is just so wired differently. Like this isn't hard arithmetic or anything. It's just tying.
And I'll tell you, in fact, none of the stuff we're doing in finance is hard. It's all basic addition, subtraction, multiplication, division stuff. That part, it's what is the number telling you, right, Madison? What is it telling you, and what do I need to do with that information? What am I finding out about a company, and what's my next step? Okay. All right. We got a few minutes. Let's try to look at problem 11. We should be able to get through this one. Okay. Market versus book value. Okay. We've taken care of our sports folks. We had Logano's Racing. We did Middle Earth with the Bilbo Baggins problem. Now we're into our sci-fi folks, and we're talking about Klingons, Star Trek folks, I guess. Okay, Klingons. Okay, Klingons purchased new cloaking machinery 3 years ago for $6 million. The machinery can be sold today to the Romulans for $5.1 million. Klingon's current balance sheet shows net fixed assets of $3.4 million, current liabilities of $895,000, net working capital of $235,000. Current assets and current liabilities are liquidated today. The company would receive $1.15 million in cash. What is the book value of their total assets? What is the market value of their total assets? Woo! Got all that? Okay, folks, here's what you got to do. You got to get rid of the fluff and only focus on the facts. Imagine that, right? We got to focus on the facts and facts only. So one of the things I like to do with word problems is let's go into it, grab the numbers, and forget the rest, okay? So the Klingons purchased new machinery today for $6 million. So the $6 million, what is that? What's that number?
Is that the book value?
Not the book value, because they purchased it 3 years ago.
Okay, the market value?
No, not market value. Kaylee's trying, at least she's out there on the branch, right? Kaylee, that's our initial cost. That's what you paid for it 3 years ago. Okay, $6 million. Oops, we just lost somebody. All right. The machinery can be sold today to the Romulans for $5.1 million. What is the $5.1 million?
Is that the market value?
There you go, Aiden. That's the market value of my fixed assets, right? Because it's machinery, property, plant, and equipment. Market value of fixed assets. Current balance sheet shows net fixed assets of $3.4 million. So what is that number? Book value, that's the book value, because that's what it's showing on my books for, right? Current liabilities, so we know 895. Current liabilities, okay? 235, we know is net working capital, okay? What's the 1.15 million? If current assets and current liabilities are liquidated today, the company would receive 1.15 million. So what is that?
Market value, current asset.
There you go. Good job, Kirsten. Market value, current assets. Okay. So now I've got the numbers I need. The rest of that's all fluff stuff. I don't need all that other stuff, right? So it says, what is the book value of the Klingon asset? So if we're looking at book value, or I'm sorry, total assets. whoops. Book value, total assets, okay? So we look for book value of current assets. I look at my numbers. I don't have book value current assets. What can I do? I have net working capital, and I know net working capital is current assets minus current liabilities. So 235 equals current assets minus 895. So my current assets must be how much?
1,130,000.
1,130,000. There you go. So 1,130,000. Okay. Then I need book value of fixed assets. Do I have that number? Yep. $3.4 million. Okay. So I can see now the book value of my total assets is $4,530,000. Is everybody good there? Okay. Now let's look at market value of total assets. Okay, so first I want market value of current assets. Do I have that number? Yep, 1,150,000. Then I need market value of fixed assets. I have that number. So the market value of total assets is 6,250,000. Okay. Let me ask you this. Is it good that my market value is greater than my book value? Madison, what's the answer to any of our questions when it comes to a business?
It depends.
It depends, right? What happens if market value is greater than book value? If I decide to liquidate my company, right? Do I get to keep all of that money?
I mean, it's technically a gain, so, but you wouldn't, not technically a gain, but it could be a gain, correct?
No, it is a gain.
Oh,
It's
okay.
profit because the book value is only 4,530,000, but my market value is 6,250,000, right? So I'm going to pay now. What's the difference there? What's the difference between the 4,530 and the 6,250?
$1,720,000.
All right. So I show a profit. Okay. I'm going to sell it for 6,250,000. I'm only showing a profit of 1,720,000. Do I get to keep the whole 6,250? No. I got to pay taxes on the profit. Okay. So I got to pay taxes on $1,720,000 of profit. So whatever my taxes is, that's coming out of that 1.7 number, okay? So whatever that is, that's what I'll get to keep. Now, let me ask you guys this, and we'll stop with it. I know we're getting over 2 minutes. Give me 2 minutes. What if book value is, say these numbers are switched so that the book value is greater than the market value, and I sell it for $5 million or $4,530,000. What's my situation there if my book value is 6,250,000? Did I make a profit?
No, it's a loss.
I made a loss. So do I get to keep all $4,530,000? No. At the time of the sale, I still have to pay the taxes on it. But at the end of the year, when I file my taxes, if I have a loss, the sales tax that I paid, guess what's going to happen to that?
The government will pick it up.
I get it back. So I will get to keep all $4,530,000 eventually. Maybe not at the time of the sale because I got to pay my sales tax. But when I show my loss because I liquidated, I will get that back. Okay. That's why the difference between market value and book value is important. Okay. Is everybody good there? All right. So here's what I want you guys to do. For Thursday, I want you to finish the rest of these problems. And like I said, guys, if you don't come with questions, I know you didn't even look at these problems. I guarantee it. The other thing I'm going to tell you is problem 16 is one of my favorite problems in this book. It's going to give me some insight into how you guys are thinking as business people, not only business owners, but managers of a business. Okay. So take a look at those problems and we'll finish this up Thursday. Okay. All right, guys. Have a good one. We'll see you later.
Thank you.
Thank you.
Could you scroll up real quick, please?
On this page,
Yeah, on this one. Yeah.